Welcome to Lesson 1 of the DCF Valuation course. Before we learn how to build models or calculate financial metrics, we must understand one fundamental question. Why does valuation matter? This lesson will give you the foundation for everything we will do next. Valuation is the process of estimating how much a business, project, or asset is worth today, based on the cash it is expected to generate in the future. It is the financial language behind investment decisions, mergers and acquisitions, IPOs, and strategic planning. One of the most important concepts is the difference between price and value. Price is what you see on a screen, driven by market emotions, supply, demand, and short-term sentiment. Value is what a business is truly worth, based on fundamentals. Valuation helps us identify when price and value do not match, and where opportunity exists. Valuation is essential in many real-world situations. Investors use it to decide whether to buy or sell a stock. Companies use it to evaluate new projects and allocate capital. Investment bankers use valuation when advising on mergers and acquisitions. Private equity firms rely on valuation to set target returns and exit expectations. Management teams use valuation to guide long-term strategy. Different stakeholders rely on valuations for different reasons. Equity investors want to understand upside and downside. Lenders and bondholders care about risk and debt repayment. Management teams use valuation to support budgeting and strategic planning. Boards and shareholders use valuation to approve major decisions. Valuation is the common language that connects all these stakeholders. The discounted cash flow valuation, or DCF, is built on a simple idea. The value of a business equals the present value of all the cash it will generate in the future. DCF helps us to understand the growth, profitability, reinvestment needs, and risks of a company, making it one of the most powerful tools in finance. Valuation is not just a number, it is a decision-making framework. It helps us assess trade-offs, compare different opportunities, and understand the assumptions behind business performance. Two people may calculate different valuations, but both must explain the story behind their assumptions. That's the real value of this process. Valuation is rarely a single precise number. Instead, we think in ranges: base case, upside, and downside. This reflects uncertainty and acknowledges that many future outcomes are possible. Thinking in ranges makes valuations more realistic and more credible. Whether you want to work in investment banking, private equity, equity research, corporate strategy, or simply become a better investor, understanding valuation is essential. It gives you the ability to challenge assumptions, communicate clearly, and make decisions based on evidence, not emotion. To summarize, valuation helps us determine what a business is worth. Price and value are not the same. Many real-world decisions, from investments to acquisitions, depend on valuation. DCF is a fundamental tool because it connects value to future cash flow. In the next lesson, we will explore the key valuation approaches used across the finance industry. Thank you for watching Lesson 1. When you're ready, move on to Lesson 2, where we'll break down all major valuation methods used by investment professionals.